Hello, team. We're bringing the non-live version of how to get tax smart to you here, and apologies again about all of the technical issues through the session today. But I'm going to record all the content so that you've got it all at hand to make sure that you're being as smart as you can before the end of financial year. Look, there, yeah, bunch of content which you can check out if you're new to what we do. A heap of events coming up on Eventbrite, and my new book, Replace Your Salary by Investing, does deliver end-to-end game plan around how to be smart with tax, but ultimately how to create financial security and freedom. Give that a check out. And on that page that's listed there, pivotwealth.com.au/RSI, there's a bunch of free tools and resources that you can use to level up your money game. Here, guys, please don't rush out to make any life-changing decisions off the back of what we cover. We strongly suggest you seek out personalized advice. I talked about the fact that financial potential, like there's certain things that everyone can do that can improve the financial trajectory that they're on. Spend less money now, spend less in the future, earn more money, invest more in sprint style, pay less tax, more leverage, more risk. My favorite one of all of these levers is paying less tax, because paying less tax is the only one where you can get more without doing more. You don't have to sacrifice anything. You can just use the money that you've got smarter, and that will help you get ahead faster. But it's not easy. That there are common challenges that slow people down and hold people back when it comes to their tax. First is that the rules are complex. They're complex and confusing. There's hundreds and hundreds of pages of tax law out there. There's also a bunch of unknown unknowns, and that stops people from pulling the trigger on stuff because they don't want to do something dumb that ends up costing them a bunch of money. And the third is that good help is hard to find, hard to know who to talk to in the first place. But then, who are the right people to solve the right problems when it comes to your tax? And I'm going to talk a little bit more about that as we go through today as well. There are three things that you need to get right if you want to be successful with your money, which is structure. It's making it easy to save and manage your money, making it clear how much money you've got to work with when it comes to your saving, investing. And that's really, really important for your tax strategy. So knowing what you've got to work with that you can then use that will narrow down the field of what investments make sense. And that's going to also shape up some of your decisions around tax as well. Strategy, which is the next piece, and that's really optimizing the pathway that you're on, choosing the right pathway for you, and then optimizing it for the best after-tax outcomes. And then investments and the solutions that you use to back up your strategy so you get reliable, consistent progress over time. But importantly around tax, using tax-efficient investments that have more of an impact. And I'm going to unpack some of those as well. So, first thing, tax basics. Now, in Australia, we work under the marginal tax rate system. That means that we've got a progressive rate of tax where the more money you earn, the higher the rate of tax is that you pay. You only get one tax rate. So, one tax rate for all your investment income, all interest income from bank accounts, dividend income from your share portfolio, all of those things, that all of your income adds together and then is taxed at your marginal tax rate. Now, these are the tax brackets here. So basically the first $18,200 of income that anyone earns is taxed at 0%. Then $18,000 to $45,000 taxed at 19%, $45,000 to $120,000, 34.5%, $120,000 to $180,000, 39%, and $180,000 plus taxed at 47%. Now, one thing that confuses a lot of people when it comes to tax is that even if you earn $500,000 a year, you still pay 0% tax on the first 18 grand that you earn. You still pay 19 cents in the income earned in the next bracket. So there's no point whereby if you earn more money, you pay, you end up with less money after tax, essentially, is the way to think about that. There are different tax rates for different entities, though. And entities is a little bit of jargon, but it's essentially basically like an entity is anything that has a tax file number attached to it. So every individual has a tax file number, every company has a tax file number, every super fund has a tax file number. And if you can choose to invest in your personal name, but you can also choose to invest through your super or through another tax entity, and then it will have different rates of tax that apply. These are the different tax rates here. So in your personal name, any investment income is taxed at your marginal tax rate. If you invest through your super, though, it's taxed at a maximum rate of 15%. Through a company, 30%. And then a trust, I'll talk a bit more about trust as we go through, but a trust essentially doesn't pay tax but distributes income to another tax-paying entity, and that tax-paying entity pays tax at their applicable tax rate, essentially. Now, for individuals, investing is the biggest area to save on tax because there is a limit to how many deductions you can get. There's a limit to how many bits of stuff you can buy for your home office space or whatever. But when you think about investing, when you think about actually getting ahead with your money, ultimately you want to build enough investment income to replace your salary. That's why I called my book that, because for me that's the definition of financial freedom, that you've got enough investment income coming through so that you're working then out of choice as opposed to necessity. So if you think about what that actually means, it means that you're going to have like $50,000, $100,000, maybe more of ideally of investment income that builds up over time. So paying less tax on that income alongside your salaried income while you choose to have a salary is going to make a big difference to your overall tax position. But I'm going to dive deeper into that. But I firstly wanted to talk about some of the hacks and things that you can do before the end of financial year to cut your tax bill. Now, the first one is understanding your deductions and keeping good records. And the reality here is that most people miss out on claiming tax deductions because they don't do this, because they don't understand what they can claim and what they can't, and they don't keep good records, or both. Now, the ATO has some really helpful information on their website about what you can claim for different types of occupations, and it's a really important. It's really important knowledge to build over time and to have, so that throughout the year you can make sure that you're tracking everything that you can deduct and make it easy for you at tax time. Now, keeping good records is another thing that you need to be able to substantiate your claims. And so if you don't have good records, it can be hard to find all of those at the end of the financial year. So snap a photo of your receipts, file it away on your phone, use a shoebox. Not that great an idea, but if it really works for you, then go for it. Or one of the apps, the ATO app I've heard is quite good for this. I haven't used it personally, but here it's good around keeping good records. And that has the added advantage of making it really easy when it comes to tax time, that you have everything there and you can just crank it out, do your tax return faster, get your tax refund faster. Prepaying interests and expenses before the end of financial year, that's another immediate one that if you're talking about prepaying expenses first, if you've got expenses planned coming up, say you've got some stuff that you need to buy for your home office, or you've got some maintenance that you need to do on your investment property, having those expenses land before 30 June instead of after 1 July means that you claim the deduction a full year sooner and you get the tax back a full year sooner. So that can be really helpful. Now, if you've got investment debt, then potentially prepaying interest costs is another way. You're just bringing forward expenses that you would otherwise incur and getting those deductions a little bit sooner. Now, with this, it only works if you were going to spend the money anyway. So there's no point if you spend money on something, even if it's tax deductible, it still costs you money after the tax deduction. So you only want to be spending money that you're bringing forward expenses that you would otherwise spend, so that you end up ahead. But if you do have these things, then it can mean that you're getting money back a bit sooner. Paying for advice and education is another thing. So tax advice, financial advice around investment income, deductible under the ATO. So having some of those advice things can help you to, one, save more tax, but also create some deductible expenses that can further reduce your tax bill. Also, self-education expenses. So education expenses, anything that increases your income over time. We tend to spend a lot of money on this stuff, so make sure that you're claiming it. The ATO says that if you do self-education, whether it's an online course, training program, or formal study, that it doesn't have to be like, if you're a marketer, it doesn't have to necessarily be a marketing course, but it just has to relate to your income. So if it's something on user experience, or we even had a client that ran their own business that did a cooking course, and she did that course in part to look at the user experience of that course and to optimize her own user experience in her business. So because that links into her increasing her income, considered valid self-education expenses by her accountant. So again, I think the average spend for an Aussie on self-education is $1,900 a year. If you've got things in there, make sure that you're claiming them. Another thing before the end of financial year, and particularly given the year that we've had in markets, that if you do have investments and share investments, probably more so here, but investments that are sitting at a loss, selling them before the end of the financial year can offset gains that you've made throughout the year as well and mean that you pay less capital gains tax. So that's an easy one. Now, the ATO, they don't want to see you selling investments and then rebuying the same investments. But if you've got investments that are underperforming and you're looking to restructure your investment portfolio, you create a loss that offsets other gains, and then your overall tax position is lower. Making sure you got private health insurance and hospital cover in particular so that you don't pay the Medicare levy surcharge is another thing here. Basically, if you earn over $90,000 for an individual or $180,000 for a couple and you don't have private hospital cover, you end up paying more tax, up to 1.5% of your income in tax. So it can be like $1,000 to $2,000 or even more, depending on what your income is, if you're above the threshold and don't have this cover. So given that for a lot of people, and particularly if you're older, it's a bit more expensive. If you're younger, it's a bit less expensive. But having having that insurance is generally cost less than the extra tax that you pay if you weren't above that threshold. So make sure this is different. And there's a bunch of confusing things around Medicare levy surcharge. Then they've got the age-based surcharge as well. But essentially, this Medicare levy surcharge applies if your income is above the threshold. So understand that rule and don't get caught out by it. Tax strategies and some of the things for you to be on the front foot with here. The first, and this is a simple one and not actually a strategy in and of itself, but planning in July, as in at the start of the financial year, and April for the financial year that you're currently in, is really important. Now, a lot of people don't think about their tax planning until June of a financial year, and then they're going, what can I do in this financial year to reduce my tax position in this financial year? But reality is that sometimes in some of those things, it can be too late at that point to change much that has a really material impact. Whereas when you plan on the 1st of July, you can look at the whole tax year coming up and start to make smarter moves now, which are things that don't necessarily have an impact tomorrow, but will impact you by 30 June. Then in April, you want to just check in and make sure that you're giving yourself plenty of runway to make smart decisions before the end of the financial year as well. So that's the right time to be doing this stuff. Now, franking credits are your friend here. Now, franking credits are essentially come when you invest into shares, and specifically when you invest into Australian shares. Now, when you're a shareholder, what happens is that you're entitled to a portion of the company's profits. You end up owning a tiny little percentage of a company, and then the company makes money. They make a profit, they pay tax on the profit, and with the money that's left over, they reinvest part of it into the business, but then they pay out part of it to their shareholders in the form of dividends. Because dividends are paid generally with profit that's after tax profit, then the ATO are kind enough not to tax that income twice. So when you receive your dividend, you receive that dividend with a tax credit attached to it, which reduces the overall amount of tax that you pay. Now, I was just putting this together for another piece of content. Basically, if you're investing, say, $500 a week, that's $26,000 a year. Based on the average income on Australian shares, 4.5%, it works out to be about $1,000 in investment income that you earn in a year on $26,000 on a $26,000 investment portfolio. If that income is received with franking credits attached, you get a $300 odd tax credit attached to it. That means that overall, you will pay $300 less tax in that year because of those franking credits. Now, that's year one. That gives you a benefit in year one, but if you keep following that strategy through, it compounds every year. And I looked at it, if you extrapolate that out over 20 years, the tax benefit is over $10,000 a year as a result of doing this. So it's a bit of a free kick. And the beauty with franking credits is that you don't need to actually do anything to access them. You just need to choose investments that pay dividends that have franking credits attached to them. So super powerful, super easy, and a really effective way to reduce your tax. Negative gearing is another one, and everyone's probably heard that term. People do get a little bit confused by it, though. Essentially, gearing just means borrowing money to invest. So anytime you borrow money to invest, that is gearing. And then the negative part refers to the cash flow of your investment. So where it commonly happens is with buying an investment property. With an investment property, you've got income receipt. That's an investment property. On that investment, you receive income in the form of rental income, and then you pay expenses, mainly your mortgage costs as well as strata and other random costs. Now, with that, with the loss that you make, so if your rental income is $20,000 and your total cost and mortgage payments are $30,000, your out of pocket is 10 grand a year. You are able, with negative gearing, to claim that $10,000 as a tax deduction to reduce the amount of tax that you pay. So when I said you only get one tax rate, it does add up your income, like your salary income plus interest income plus dividend income and everything else. But then it also, if you've got negative income from negative gearing, it reduces your overall assessable income and therefore reduces the amount of tax you pay. So the benefit there is really powerful. And on top, you get the gearing benefit, which is that you've borrowed money to invest. So you've got a big asset that's actually working and growing for you. So you're getting two bites of the cherry there. Investment bonds are another one. And essentially, with an investment bond, it's a tax structure. It's a specific tax structure, sort of like a super fund in a way, where it's essentially an investment account which is subject to specific rules and specific tax rates. So basically, the two big benefits for investment bonds from a tax perspective is that all income is taxed at a maximum rate of 30%, and often it's lower than 30%, but maximum rate is 30%. So that's all dividend income, 30%, which is much lower than most people's marginal tax rates. If you earn over 45,000, your marginal tax rate's 34.5%. So you're already saving 5% in tax there. If you're in the top marginal tax bracket, you're saving 17% tax on that income, which is pretty significant. The other good thing with investment bonds is that if you hold your share investments for 10 years or more, then they are you don't pay any capital gains tax. So completely CGT free. And that makes a significant difference to your overall return as well. These products used to be really clunky, really expensive, and not be that good. But in recent years, there's been a renewed focus on them. And there's some really sharp products out there where you can invest in basically any shares, well, most shares that you would otherwise buy, or ETFs or managed funds or index funds, which we use pretty extensively at Pivot. Investing in these funds through investment bonds does save you a ton of tax over time, but there are restrictions on access. So you want to be really careful with these and get good advice before you jump in, because you're probably talking about significant, thousands of dollars, tens of thousands of dollars in tax savings. Make sure you structure it the right way from the start. Debt recycling is one of my favorite strategies. Maybe it is my favorite strategy. Not sure, but it's definitely one of my favorite strategies. I think it's my favorite strategy. Essentially, it's where debt recycling works because when you own your own home, your mortgage interest is not tax deductible. So, what debt recycling does is it converts your non tax deductible home loan debt into tax deductible investment debt over time. Essentially, how it works is that it only works for homeowners that live in your own home, that have a non-tax deductible mortgage. And essentially, if you have $10,000, you pay it down on your non-tax deductible mortgage. At the same time, you draw the money out and then invest it into a share portfolio. And because the reason that you're investing that money is to invest, it makes that portion of the interest cost tax deductible. Now, there's some practicalities to consider with this one around, how you structure it. Do you use the right product? Do you use a line of credit? So again, you probably want to make sure you're doing your research here, but it has the potential to create tens of thousands of dollars of tax deductions and save you tens of thousands of dollars of tax. So it's really powerful. Super contributions, a pretty simple one, but you're able to make tax deductible contributions of up to $27,500 to your super fund each year, including the money contributed on your behalf by your employer. Now, with for most people, that leaves a pretty significant amount of room to make some tax deductions, because when you put money into your super, you can't access it until you're old. It's probably not going to be your go-to strategy for all of your money, but because of the tax benefits, they're really compelling. You get tax deductions on the way in. And then also, once the money is inside your super fund, uh, it's taxed, the investment income earnings are taxed at a maximum rate of 15%. So it means that that money inside super will grow faster as well. So really powerful. A few tax stories to talk about. I just got some recent clients that had some tax wins, and I thought I'd put these in here to give you an insight of some of the things that are possible. Now, this first one was a couple. They were in their late 20s, combined income $220,000. They had 130 grand in savings. They'd never invested, and they were saving at a solid clip of $4,000 a month. They wanted to buy their dream home, $1.2 million, but they didn't have any family support to get into the market. They In order to buy that $1.2 million home, as they figured it with their planning, that they needed to have 300 grand for their deposit and to make sure that their mortgage was at a level that they were comfortable with. They felt that that was 3 years away based on the runway that they had in place. When we started talking, we realized that there was a big opportunity for them to sort of tweak their strategy a little bit and have a much better outcome. So what they ended up doing, they use the First Home Super Saver Scheme, which allows you to contribute up to $50,000 per person into your super and then take it out for the purpose of buying your own home. They, at the same time, invested some of their savings into the share market and their regular savings. They bought an investment property, or they aimed to buy an investment property at $900,000, but they lived in the property for 6 months to make it their home so that they could use the First Home Super Saver Scheme. What that also allowed them to do was purchase the property 2 years sooner, avoid paying all lenders' mortgage insurance on their property, and they saved $13,500 with the First Home Super Saver Scheme, plus got some upside from their investments. And they set up for an even bigger tax benefit down the line in that they used the 6-year rule, or the intention was to use the 6-year rule, so that because they'd moved into their property and made it their home, you can then move out of the property and run it as an investment property for 6 years without paying any capital gains tax. So while there was upside of 20 grand in the first year, that the upside down the line would have been tens of thousands of dollars more. Distrust and debt recycling is another one that these guys, they ended up, it was a couple, $150,000 and $200,000 income. They had a home, 1.3 mil with an $800,000 mortgage, an ETF portfolio of $175,000, and was saving 6 grand a month, half invested, half saved. They were frustrated by their tax bills. They were paying a ton of tax, and they wanted to get ahead, but they didn't. They were having a bit of a trust issue with getting some help. What we ended up doing for them, they realized, because they had a strong savings capacity, purchased an investment property, $1 million, but they did a debt recycling strategy because they already had this share portfolio. They basically sold the share portfolio, got the proceeds, paid down their non-tax deductible mortgage, and then drew down on tax deductible debt to invest, and immediately got tax deductions of $12,000 in the first 12 months. On top of that, they got the property upside. And so that basically, by making a couple of small tweaks and purchasing a property, annual upside of $53,000. That's a per annum benefit that these guys got from these changes. Last one is this couple that we were working with on a pretty solid income, $260,000. They had their total assets were $370,000, where they were saving and doing a bit of investing each month. When we started talking, they really wanted to buy their dream home. They were investing without a lot of confidence, and they were frustrated with the tax that they were paying. But the thing that we realized was that they were actually, in the couple, she was earning 200K and he was earning 60,000. But all of the investments, because she was more the organizer around the finances in the couple, that she had set up the investment account and she set it up in her name, and it meant that she was paying a way more tax than she needed to. So for these guys, what we did was we switched over the investments to the partner's name, also used the First Home Super Saver Scheme, created $6,500 of tax saving in year one, but then that compounded every year into the future. Now, these guys ended up investing an extra $60,000 into the share market in the first 12 months, which we looked at that 60 grand and how it would grow by age 60. It was $937,000, which everyone was pretty stoked by. But because they'd been thinking about making these changes for 2 years, we started looking back and said, what if they had started a couple of years sooner? we realized that if they had, that the upside would have been 1.14 mil. So the actual opportunity cost was $202,000. Now, these guys, while they were on a good path and they're going to be fine, they realized that they essentially left 200 grand on the table by not pulling the trigger on this stuff sooner. And this is why it's so important, guys, to nail it with your tax planning and be really on the front foot. So you're taking advantage of opportunities when they come up so you can actually take full advantage. Some tax myths and mistakes here to look out for. Look, the first one, staying in a lower tax bracket. Again, I touched on this at the start, but people think that you need to stay in a lower tax bracket or you're going to end up with less money after in your bank account after tax. Not the case. Hex is a bit of an exception to this because the hex brackets are linear in that you go up into a hex bracket. That higher rate applies to all of your income. But ultimately, hex is you ditching your hex debt, which is something that you need to do anyway. Offset versus redraw. This is a major mistake that people make where the ATO treat it differently if you pay money into your debt and then redraw it out versus put money into an offset account and redraw it out. How this works, and to use an example with round numbers, if you buy a property for $500,000 and then you take out 400 grand of debt, if you pay that down and then you want to upgrade your property in the future, you redraw the 400 to upgrade your home. Because the purpose of that redraw is to buy a home and not an investment, that means that the interest on that debt is not tax deductible. If you put that money into an offset account and then take it out of the offset account and use it as a property deposit, and then you move out and turn that $500,000 property into an investment property, then all of the debt is deductible because the purpose of the debt was for that particular property, and then that property is now an investment property. Seems quirky, but I've seen a lot of people that get this one wrong, and it can be a really expensive one. Not tax planning before investing is another one. People, do a bunch of stuff and then deal with it later. Look, getting started is really powerful and important, but you want to plan before you invest so that or certainly before you start investing heavily and start building serious momentum with your investments so that you know that you're taking full advantage. Advice with an agenda, particularly around structuring entities. If you've got an accountant, a lot of great accountants out there for sure, but sometimes accountants can suggest setting up self-managed super funds or trusts when the benefit is marginal at best, or sometimes not that beneficial at all. So again, when it comes to tax, just keep in mind that you want to ask lots of questions and make sure you're comfortable and that the benefits are really clear before you pull the trigger. Some common tax questions that we get. So the first one is who helps with tax? And this is a major frustration for a lot of people where they want to, they naturally think that an accountant is the person that helps with tax. And they absolutely are. And they're the ones that help with doing your tax return. But there is a real clear line and compliance line between financial advice, investment advice, and accounting and tax advice. So because the biggest opportunity area for individuals is through investing, accountants' hands are a little bit tied around making recommendations around what you should do with your investing to reduce your overall tax position. And that means that while an accountant is really important for doing your tax return and some of the compliancy tax type elements, often if you think about optimizing your tax position over years, you're probably more talking about financial advice than accounting advice. Finding a good accountant, though, is important. And this is a common question, that you want to find someone that, one, charges enough. That's the first thing. It is a bit of a race to the bottom in the accounting space. And most people think that a tax return is a tax return is a tax return, and they're trying to find a cheap solution. But the less you pay, the less time your accountant is going to spend with you. And if having someone that educates you around what's actually important and holds your hand to make sure that you're maximizing all of your deductions, excuse me, then you want to find someone that's charging enough to deliver what you want. Most overlooked deductions. So I've got a list of these here. Financial investment advice is one of them. So getting advice around investments and building your investment income, self-education expenses, career coaching. This is something that a lot of people don't think about, but increasing your income is a really, really powerful way to help you get ahead faster. So if you're getting coaching around that, can be deductible, often is deductible, but also importantly, it helps you actually increase your income and massively increase your financial trajectory. Home office expenses, again, knowing what you can claim and keeping the records, travel costs, and investing fees there as well. I think this is the last question. Do I need a trust? You only need a trust when the benefit of you having a trust is more than the cost that you pay for setting up and then managing a trust. What that means, and there's no hard and fast rule here, but you want to have at least bare minimum 6-figure investment portfolio, or a really strong, if you're saving, $5,000, $10,000 a month, like a really high amount, then again, it's worth looking at to run the numbers and make sure that it might work. But trust can save a significant amount of tax, but they're not for everyone. So, next steps and where to from here. Look, guys, I hope you've got some good tips there. I feel like tax is a huge opportunity, but it's also not that well understood. So, yeah, ultimately, there's a bunch of things that you can do, but I wanted to share this model with you, talking about getting from where you are to future state with your money. Essentially, he talks about, for most people, when they think about getting to future state, they think about their progression like a straight line, but you're going to be somewhere on this spectrum of really bad to really good. But because of the compounding impact of time and money, it's actually not a straight line, it's a curve. So if you're not 100% on track to end up exactly where you want to be with your money right now today, you need to do some stuff to what we call jump the line. Be smarter with your tax, optimize your savings, investments, whatever. And when you do, then your next steps become easier, because you just need to keep taking the next step and the next step and the next step, where you're already on that path. But the more time goes on, the longer you leave it, that jumping the line piece becomes more and more painful, and putting yourself in the best position can become impossible. So the sooner you start, the easier it is, and the less you need to do to end up in the same spot. Guys, I hope you found that helpful. Again, apologies about all the tech issues earlier on. I'll leave you with this quote from Derek Sivers. Says, if more information was the answer, we'd all be billionaires with perfect abs. So hopefully you guys got a bunch of great ideas today, but know that the power of an idea is in its implementation. So you want to take the time, put this, it won't just happen on its own, this stuff. You've got to make it happen. So, hopefully you got those ideas. Now it's over to you. As I mentioned on the live session as well, if any questions, feel free to hit me up and I'll do my best to answer as many of those as I can. Cheers, guys. We'll catch you next time.